Please don't get confused. When you're investing in Bitcoin, when you're holding over the long term, there's only two things that matter. The first thing is you need to identify pretty reliably when Bitcoin is depressed enough to heavily buy in. The second thing you need to identify is when is Bitcoin heated enough that it makes sense to change your hard-earned Bitcoin, your hard-acquired Bitcoin, into something weaker that's fiat. You only need to identify those extremes. Whatever happens in the middle is very hard to anticipate, and there are very good models to anticipate both, to identify, are we currently very depressed, are we currently very heated? And I'm going to go into both of those models that are very reliable in this video. So let's jump in. The first model is simply detecting when is Bitcoin very depressed. And this is not just like random lines drawing, this is actually figuring out psychologically when are people less likely to sell, because that's when we are low, right? We are low when people are not selling anymore, when the selling is pretty much over. And what I'm looking here at is the realized value. This orange line over here, the realized price. So that's the orange line. This is the price at which Bitcoin in aggregate has moved in the past. So the current price is simply just recently, right? The latest Bitcoin, at what price did it move? But before that, there were other Bitcoins that moved, right? And they moved, say the Bitcoin price goes up, they moved at lower prices. So the realized price will be on average below the recent price if the price is rising. Now the same is true the other way around, right? When the price is crashing, just the recent person sold for this low price, but all the people below that, they sold for higher prices. So you want to know in aggregate for the entire market, is the market in aggregate in profits or in losses? Where is the current price relative to the realized price? And that's this chart over here, and it's super useful. Whenever the price is below the realized price, that's when the market in aggregate is in losses. So this means that there is less likelihood that further selling will happen, because we all know that Bitcoin over the long term tends to appreciate versus fiat because its inflation is lower. So if we all believe that Bitcoin will still be around in 5 years or in 10 years, then over those 10 years, the low inflation of Bitcoin, there's actually negative net inflation because more Bitcoin gets lost over time, but that's for another video. The very low inflation compared to the higher inflation of fiat should, over the many years, help Bitcoin appreciate in terms of US dollars. So if Bitcoin is currently depressed and people are in losses, they are less likely to sell. They're simply just holding on and wait it out until the price recovers again and simply just let tokenomics do their magic. And this is what you have seen all the time in Bitcoin in the past. Whenever the price was below the realized price, that's when you can DCA in very aggressively. When you can dollar cost average in very aggressively, you can buy and buy and buy, because in aggregate, the market is at a loss. So there isn't a lot of additional sell pressure happening in aggregate. People simply just wait it out. So we had this after the crash in 2018, right? The ICO crash. Then we had this also during Corona. We went slightly below the realized price. And then after the Terra Luna collapse. So this was the Luna collapse. Then afterwards we had the FTX crash. So this is really when you want to be buying in heavily. Currently we are above. So this doesn't necessarily mean that we shouldn't buy anymore, but it definitely means we are not at these crazy depressed prices where you can buy very heavily, where you can almost take a personal loan for buying Bitcoin. That's possible as well, right? I made another video on this. Maybe this comes directly after this. I personally took a personal loan in order to balance out my Bitcoin exposure. So this is the ultimate bottom signal. The ultimate bottom signal is simply, where is currently the price relative to the aggregate market? Are we currently below the realized price or not? There is a slight variation of this, which also tries to identify the tops. I don't like that signal that much though, but I do want to show this. And that's the market value to realized value Z-score. So this again looks at the same line. So look at this blue line here, right? This is the same as this orange line here. So it's the realized price that we see in blue. And then we have this orange, very squiggly line, right? That goes up and down a lot. Whenever we are here in green, right, in this green area, that's also when the price is below the realized price. That's actually when you should be buying. But this model also tries to identify the tops, and it does a somewhat okayish job at this, right? It in the recent peak in 2021. It didn't go as high as in the past. But the idea is here that you try to figure out how much is the price extended from the realized price. So how much are people actually in profit? And you put this in relation to how much is Bitcoin in general moving at the time. How volatile is the price? Or what's the standard deviation of the price? So this is what you have over here. What's the market cap, or the current price, minus the realized cap, or the realized price? So what's the delta? How much gain do we currently have? And how is this in relation to how much the price is moving, the standard deviation, the volatility of the market cap? So in other words, you allow for more profits to happen if there is already a lot of excitement and movement anyways. And when it's rather calm, then you want to be exiting earlier, and then you've got this top signal a bit earlier. So that's the idea of the MVRV Z-score, the market value to realized value Z-score. Simply just putting the profits that people have in relation to the volatility, trying to identify tops. Works somewhat okay. But now let's look at how we can actually identify tops. And I think the best way to identify tops is to look at when are the people that tend to hold Bitcoin over the long term, when are they selling? When are they selling to the speculative money? Because that's how these waves are actually generated, right? The waves are generated by simply Bitcoin becoming tighter and tighter over time. The supply, the liquid supply, gets tighter and tighter because of the people that dollar cost average in. Then this creates a price momentum, right? The price tends to rise and rise because it's more and more scooped up by the long-term investors. And then when the price has risen enough, that's when the media will cover it. That's when your random friend that never talks about Bitcoin suddenly asks you about Bitcoin. That's when all the attention comes into the space. And that's then when the short-term hands get into the space. They simply just want to ride this current wave. They don't have the fundamental belief in Bitcoin to hold it over several years. And that's then when the price suddenly stops rising just a little bit for just a few days, when these very nervous people that just recently bought Bitcoin, that expected to further rise, they might then panic out and they sell. So the Bitcoin moves from the strong multi-year holders to the short-term holders. And one way to figure this out is currently a lot of movement happening from long-term hands to short-term hands is the value days destroyed, or VDD. So this is a moving average of all of this, simply just to smoothen this out a little bit. But the idea here is the following. If you're holding Bitcoin, say you buy one Bitcoin and you hold this for 1 year and don't move it. And then after 1 year, you decide to move it. Then you are destroying 1 year of value days. So the longer you have held it, the more value days you destroy whenever you move it. In other words, when there's only short-term people speculating with one another, then there isn't a lot of value days being destroyed. But when all the long-term holders, they move it out in order to sell it, when the Bitcoin from the long-term holders moves, that's when the value days get destroyed. That's when the Bitcoin lands into these short-term hands. And that's when you want to be selling. This is your actual top signal. So top signal is not necessarily price related. It's simply just on-chain metric related. When are the long-term investors loading off? When are all the people that dollar cost average in selling? And you simply just want to follow these smart people. And you see this peaks very nicely at these prices when we tend to not rise with Bitcoin that much anymore, right? We did have a few signals in the 2017 run, but we had one very clear signal at the beginning of 2021 when Bitcoin was at 40 or 45K. And it did continue to go up to 69K, but nobody can time these things perfectly. We don't actually see any on-chain metrics that flashed here at the 69K. This is because this wasn't any more retail that was buying in, but it was really the big guys, the big whales, some corporations that bought and created the secondary rally. The real rally with excitement around retail, where all the masses jumped in, that went up to the beginning of 2021. And then once that stopped, all those people rotated into altcoins, right? That's then when Ethereum first rallied, and then afterwards the altcoins rallied. That happened after the Bitcoin rally, when people transferred their profits from the relatively safe Bitcoin to the riskier bets, when all the mania broke out and when Dogecoin, etc. exploded. This all happened afterwards. But this is your top signal, right? So you've got a bottom signal where you buy really aggressively. You can also continue to buy afterwards If we are slightly above, I personally do, right? So I buy every month a bit of Bitcoin. I buy more Bitcoin whenever we are below. And I only sell when we are very, very heated, when all of the media attention comes in. Because what else does it make sense to hold fiat, right? Fiat depreciates over time. And what else do you put it in, right? Do you put it in property? That's also now very, very expensive, where sell pressure also is building up because of the higher and higher interest rates. So there isn't a lot of demand for property. Stocks also have their issues with the upcoming recession. Precious metals are one thing, but the prices there are very much manipulated as well. And the historical performance of gold, for example, versus the S&P 500 isn't that great over the decades either. So where should you park it actually if you already take profits after this little run up? I think it only makes sense to make a strong decision against one of the strongest assets that you might hold whenever it's really, really hyped, whenever you really get a lot of other assets for it. If we are not in a hype situation, simply just ride the wave, right? Simply just dollar cost average in. That's, I think, the investor mindset. So if you don't just trade, right? If you don't put a lot of focus every day on riding those waves, which you can do, of course, you can generate alpha in this. The crypto market is still very inefficient, so it's possible to generate alpha. But if you're not interested in generating alpha that much, but you're simply just interested in multiplying your wealth over the decades, in growing your wealth over the decades with a diversified portfolio, then those are the only two things you need. You need the realized price. You need to figure out how high or low are you relative to the realized price. If you're currently below, then buy very heavily. And you need to figure out, are there currently long-term holders selling? And is this happening in masses? And if yes, then get out quickly, because then there's too much attention on it. Now in the next video, I'll discuss the altcoin market. Does it make sense to hold a diversified portfolio of altcoins? Quick spoiler, I think the answer is no. More information around this is over here. Looking forward to seeing that video, and thanks for watching this one. Bye-bye.